people too often will negotiate with themselves before they're negotiating with the counterparty. Let them ask for it. Don't do their negotiation for them, right? And that's critical. And I have to reinforce this to my folks all the time. Stop negotiating with ourselves.
I'm Stan Christensen, and this is All Things Negotiation. Today, my guest is Mike Cagney. Mike is a fascinating entrepreneur, one of the most successful in FinTech. He was the co-founder and founding CEO of SoFi, which grew to be one of the most successful financial startups, I think in history. The current valuation is close to $20 billion. He then founded Figure Markets, which is looking to use cryptocurrency to disrupt the financial markets. He has big plans there. He's already had a lot of success. In the conversation, we talk about cryptocurrency, some of the unique negotiation aspects that currency brings. We talk about his early days at SoFi, dealing with investors, dealing with employees, dealing with regulators, dealing with lobbyists. It's a fascinating conversation. Welcome to the podcast, Mike Cagney.
Thanks for having me.
Mike, there's so many things I want to talk about, and mainly I want to talk about your current efforts at Figure Markets and how you're disrupting, frankly, the whole financial ecosystem through the blockchain. A couple of things for consumers. I want to make sure that people listening to this get a good sense of where things are and where they're going on the blockchain. You know, there is still a fair amount of perception that there are nefarious activities, a lot of crime. Those are the easy, low-hanging fruits. Is there still a lot of crime? Is a lot of it, going bad places? And when is it going to get down to the consumer level here in the country on payments?
Yeah, so two questions, two answers. It is massively overblown about blockchain being used for nefarious activities because blockchain is a public ledger. And, a great example of this is you might remember a couple years back, there was a ransom of a power plant in the Southeast. And they demanded, I think, $15,000 or $15 million in Bitcoin, or they were going to turn off the turbines or whatever it was. They'd commandeered the control of the power center. And the power center paid the $15 million in Bitcoin. And that was the end of the story that you saw in the public domain. The feds then went in, tracked the Bitcoin, subpoenaed the wallets, got the Bitcoin back, and arrested the people that did the ransom because it was all on public chain. And, if you talk to anybody at FinCEN over in Treasury, they'll tell you they can pretty much find anybody on the public blockchain. They know what wallets are bad, what wallets are good, and they know how to.
So this is a public service announcement for anyone thinking of taking someone hostage. Do not use the chain.
Yeah, don't ask for ransom in Bitcoin. Ask for physical currency because that's, or gold bars, right? Bitcoin is not a good medium in which to conduct illicit activity because you will be tracked and they will find you. I think as it relates to payments, the challenge that we've had is in China, you didn't have payment infrastructure. And I remember I was in China one year and I'm using my Amex card. And I literally went to Beijing the next year and I could not use a credit card. Everything was Alipay and WePay QR code scans, right? And I was thinking how cool they did that transition. They were able to do that transition because they didn't have this massive infrastructure that Fiserv and FIS monopolize that feeds into the ERPs in the back end, like does all this stuff. Because when you go on a US terminal, you're doing a card read and it's going through an issuing processor, issuing bank, Visa, MasterCard network, merchant acquirer, merchant bank, 5 parties that sit in between the buyer and seller. And it's very hard to disrupt that because how do you introduce a QR code at that point of sale? And how does that feed into the bank, the back end merchant ERP, et cetera, et cetera. What's going to happen with the stablecoin bill is you're going to get the JP Morgans of the world. And, Chase is the largest issuing bank in the world. And they're going to say, you know what, we are going to build these rails before someone builds them without us. And you're going to get a first generation of disruption, which will be cutting that 5-party interchange down to maybe 2 parties, right? Which would be them as issuing bank and then them as merchant bank. And so you need an entity like that to lean in and disrupt payments for payments to get disrupted. And they have all the incentive in the world to do it. And so I think, they already announced publicly a week ago that they have JP Coin, they're going to have their own stable. They're going to build rails. Now, whether those rails will be ubiquitous for all coins or not, I would hope they are. But the stablecoin legislation doesn't touch on that. But you will start getting that disruption. And this is what goes back to when we started the conversation, this macro event that I don't think people fully grasp, which is when I can hold my money in this phone and it pays me interest. I can go into Starbucks and buy coffee with it. I can go online and buy Bitcoin with it. I can go online and buy Tesla stock with it. I can pay my utility bill with it. Why do I have a bank account? And this dynamic is going to, the US Treasury said yielding stablecoins will take $6.5 trillion out of bank liabilities into stablecoin. Now, if you're a macro trader, there are two things to consider off of that. One is there's only $6.5 trillion of treasury bills. So you're going to get the world's greatest bull steepening of the treasury curve as that cash moves in to buy treasuries. But second, the banks are going to lose these deposits. This is the beginning of what I would consider narrow banking, right? The separation of lending and deposit gathering by the banks, because they won't have that liability network to tap into to support their assets.
And that's why someone like JP Morgan would want to get on board rather than have it done to them.
Oh, of course.
Yeah, that makes complete sense to me. Let's use that to transition to Figure. Essentially at Figure, you're using the blockchain, and obviously blockchain's in the news, and you're essentially trying to disrupt the capital markets in a pretty big way. So can you just give us a quick overview, underline quick, of what your mission is, what your values are there, how you started it, why you started it, what you're trying to get done?
Yeah, so the blockchain has three impacts to capital markets. And the first is a structural transactional impact where it can reduce friction. And we've demonstrated that with Figure. We've taken 125 basis points of cost out of loan origination, aggregation, securitization using blockchain. The second is around liquidity, because blockchain allows for bilateral transactions that self-settle, self-clear, that can trade 24/7. There's no need for intermediation. So if you think about the stock market, there's 7 people that sit in between a buyer and seller. A debit card, when you swipe it at a terminal, there's 5 parties that sit in between the buyer and seller. Blockchain distills all that down to 2 parties, and eliminating that intermediation clears up an enormous amount of rent and value. But the most important thing about blockchain is you're creating native assets on blockchain where I can look to that asset and know for certain its ownership, its composition, its history, and I can perfect an interest to it, a security interest. And that opens up the way that you lend against assets. And so from a macro standpoint, we see this transition, especially with the stablecoin bill that's getting passed. The Genius Act just made it through the Senate, and we expect it to, some permutation to go through the House relatively soon. Stablecoins, Treasury says, hey, they're going to attract $2 trillion of new inflow into U.S. Treasuries. They will, at least that much, but at the expense of bank deposits. And so, in 23, we went from $18 trillion to $17 trillion in bank deposits, and Silicon Valley Bank failed, and First Republic failed, and the capital market shut down. So $2 trillion exiting bank liabilities in the U.S. Treasuries is going to need an alternative solution. And that's where we think blockchain, and in particular, decentralized finance, this peer-to-peer lending construct, can really step in and fill that void.
One of the things I like the most about the blockchain, and I've been advocating this for years, is it's a way to take trust out of the equation. So much of negotiation is, can I trust them? And people's careers are made and lost over trust issues, where blockchain essentially takes that out. And so you talked about the cost savings, you're getting rid of intermediaries, it's 100 or more basis points. Just articulate for me, if you could, how it serves to take trust out of the equation.
Sure. It goes back to what I said earlier. If I can look at an asset on chain, know for certain its ownership, its composition, its history, that's truth. And there is no trust. And I'll give you a great example, a particular circumstance. I was trying to get Goldman to take loans on blockchain and use the blockchain registry for several years. And, this was during the regulatory headwinds that we had over the last 4 years. And they're like, well, we don't know. This public blockchain, it sounds a little scary. We think you could steal our loans, all these. And I was like, none of these things can happen. But what I did with them historically for warehouse financing is I would send them a spreadsheet full of loans. And they would comb through that spreadsheet and then comb through the files related to each loan in that spreadsheet. And when they figured out that I wasn't lying, they'd give me a bunch of money. And then I get to send them another spreadsheet.
Essentially due diligence is what they're doing.
And this process would happen every 5 days. And every 5 days, I would send them a new spreadsheet. And I said, look, with blockchain, you get these assets native digitally. You have this thing called DART, which gives you a UCC Section 8 perfection. Like, immediately whether the loans are there, whether they're performing, whether I've double pledged them. And so they finally started using it, and it took them about 15 minutes to figure out, hey, we don't have to pay the cost of people doing diligence for 5 days. But more importantly, we can lend the money out faster, meaning we start making money faster. And so this not only reduces our costs, it increases our revenue. They're like, why didn't you tell us about this? I was like, I've been talking about this for years, begging you to do this. And now you're finally doing it. And now the only loans they take from us are on blockchain. And it's not just Goldman, it's Jefferies, it's Texas Capital Bank. It's a full slew of folks in the traditional financial world that have realized how much better this structure is. And that's, we need those wins in blockchain, because blockchain has too many headline stories that have nothing to do with the value prop and all to do with some of the, ridiculousness that goes on in the space.
Let's talk about the ridiculousness for just a minute, because that's the thing that most people know about, because that's what's in the popular media. So let's assume we're not talking to someone in FinTech, not sophisticated financially, and they've heard a little bit about ICO. They've heard a little bit about, FTX. You would say that those aren't necessarily representative, but from a negotiation perspective, what does the industry need to do to overcome that negative bias based on those blowups?
Yeah, and it's, I remember one of the conversations I had with a large sell-side bank, and I was talking about using blockchain, and, one of the people stopped me and said, so you want us to use the same platform that Fartcoin trades on? And I said, well, it's not exactly the same platform, because we use Provenance, which is a different public chain. But yes, in spirit, I do. And I'm not downplaying Fartcoin. I'm sure there's a role for Fartcoin and meme coins in general in some construct, but it's a very far cry from what we do. Like, one of the challenges that we had was we knew we faced two particular headwinds as we started Figure. One was, hey, we're going to originate assets on blockchain, and we have to pick the greenest field we can to originate those assets. Like, I don't want to do personal loans again as I did at SoFi, or student loan refi at SoFi, or mortgages and compete with Rocket, because we're going to be trying to convince the market to take blockchain loans, and we don't want to concurrently be in a slugfest in terms of just trying to get those assets. And so we opted to do home equity line of credit, because we felt we could do those in a much better way than the market had done them. And much more effectively, and create an asset that the market really wanted. And the second was getting the market to buy those loans on chain. And boy, in the beginning, it was so hard to convince the market to do that. And like, capital market people would come back to me, they're like, we could sell all these loans at a much better price if we just get off a blockchain. And I'm like, well, the only reason we're originating these loans is to sell them on blockchain as a forcing function. And we had to go to all the institutions and give them the value prop, the truth over trust, all the reasons why they should do this. And, everyone said, well, what if I don't want the ones on the blockchain? We said, well, you can take them off, right? They're digital assets. If it doesn't work, just take them off the blockchain. And so slowly we began to get the buy side to start buying these assets on chain. And then that gave us some leverage to go to the sell side and say, hey, look, our buyers need warehouse financing. They need leverage. Can you do that? And universally, the sell side's like, yeah, but we're not going to do it on blockchain. And we said, well, then you can't do it, because that's the only way it's going to work. And so what we did is we used the desire to have the asset and the appeal of the asset as a forcing function to set up a stage of events, which was, get the buyers first, use that to then get the sell side to come into finance, and ultimately use that to get the rating agencies to support a rated securitization.
Correct me if I'm wrong, but I think I remember from a past conversation that we had that one way that you're able to do that was, and this is kind of classic enterprise sales, essentially convincing line people as opposed to, a CIO or someone like that. So who do you focus on in that kind of enterprise sale? And didn't you create a security that they would then have to buy? Is that a correct memory?
Yeah, and I mean, you hit an important point, which is when I started Figure, I had these great aspirations that we wouldn't have to become a lender. The technology was so good, it was field of dreams. All the banks would show up. And I went to all these banks and said, hey, look, you can originate, aggregate, and securitize assets. You can save 125 basis points. And universally, they said, Mike, this is great. We'd like to be the 10th bank to do this. And that's where...
Yeah, let someone else go first.
Yeah, it was very clear. But part of the problem was I was dealing with the blockchain groups, right? The digital asset groups. I wasn't dealing with the line. And the line is very P&L oriented. And, very, very easy conversation in terms of if you can generate more revenue or reduce costs, they're going to lean in and do it. Versus the conceptual construct of, the digital asset group or the blockchain group or whatever that the institution had. And, that was a very early lesson for me that as we went out to expand it. So for example, when we went to the sell side, we went to the line. When I went to, institutions like Goldman and Jefferies, I went to the line groups and I said, this is how you're going to make more money. And that's how we got the support and the people to lean in. And somehow, sometimes it was actually orthogonal to what the company might be doing as an overall blockchain strategy, but the line was actually getting it done.
Fantastic. Well, look, you've got a lot of headwinds. You've overcome a lot of them. There are a lot in front of you. As you think about the players that you need to negotiate with to convince them, so obviously you've got to have a customer, in this case, Goldman, but who are the other parties and how do you negotiate with them? I mean, I can think of half a dozen.
Yeah, I mean, every day it seems that I have a new party I need to negotiate with, which is both exciting and frustrating. I used to think of it as three constituents. I used to think of it as employees, customers, and investors. And I always felt that each of those three constituents was of equal value. There's certain organizations that say the customer is always right. I've never said the customer is always right. I've been in my call center before when people have been abusing my operations folks, and I'm telling them to hang up the phone, right? And you don't need to take the abuse. And obviously you want your investors to be happy with you, but your investors will force you to over-optimize to their benefit at the expense of the employees. When you think about things like the employee equity pool and how you compensate people and so forth. And vice versa, your employees all want as much as they can get, and that comes at the expense of your investors.
Mike, let me just interject there because you said something really important that I'd like to expand on. In my experience, investors care about their rate of return, essentially, and don't care too much about the employees. Have you seen exceptions to that, or is that pretty tried and true?
No, it's pretty tried and true. And that's, but it's good because you know what they're optimizing to. So you know what's important as you're having discussions with them and where you have levers to pull. And, I think in our space, in the blockchain space, and even back in the SoFi space, because of what we were doing and how novel it was, you also have regulators. And regulators are a really interesting party of which to negotiate through because they aren't commercial. And you need to start thinking through what motivates everyone across this dynamic. I mean, obviously customers want, something fast and easy, and they want to feel like you're a partner, not a competitor. Employees, having come from a trading desk, I learned very early on that employees actually want more than just cash. They also want to feel like they're doing something significant. They have an opportunity to change the world. I had my very first startup I did in 2000. I'd come off of the trading desk at Wells Fargo, and I couldn't understand how engineers wanted more than just money. I'm like, I don't know, why this is such a foreign concept. And I grew to have an extreme appreciation for it. Investors are obviously oriented around return. Regulators have kind of a mixed bag of motivations. And, I was just down in DC yesterday, and I spent the whole day talking to, different parts of the government, different parts of the regulatory framework. And, what they're very focused on their mandate, which, could be investor safety or soundness, or they could be, effectively pushing an administration mandate, which could be access to capital or lowering the cost of mortgages or what have you. And so navigating that and intersecting that with everything else that you have to manage to, it's you're really doing the proverbial juggling four balls at once. And it's hard to keep everyone happy. And so, we tend to try to drive a framework where, on the regulatory side, knock on wood, we've never run into problems on the regulatory side, but because of so much of what we do is gray, we've always taken the position of, look, is it good for the customer, right? So at the end of the day, if a regulator came in and said, why did you do this? And I say, for the benefit of my customer, that's a defensible position for me to have. And I've taken that position and it's been effective for us. And so, But certainly we're hoping in the blockchain space with legislation, we're going to have a little less grayness and a little more black and white in terms of what we can and can't do. And that'll help the industry a lot.
Closely associated with regulation is lobbying. And let's talk about that for a second, because I'm just guessing you're knee deep in that world. What have you learned about lobbyists and either negotiating with them or how they negotiate? It's my experience is that's kind of an ugly world, but have you experienced a different world?
My first trip to DC, when I saw how the sausage was made, I came away completely dispirited about democracy in the republic. I was like, geez, oh, Pete, because there's a lot of quid pro quo, and the dynamic. I was in DC yesterday. I was telling a story about there was a congressman. And I won't say who it was. It was from a state in the Southeast, who was influential in our sector, and we needed a lot of help from this congressman. And one day, one of his staffers called up and said, the congressman would like to hold a breakfast in San Francisco. It's $5,000 plate breakfast. He wants 15 seats filled. Can you do it? And completely naive about politics, I was like, well, of course we'll do it. We're just going to buy all 15 seats and, no problem. And I'll invite people to sit and have breakfast. Well, I go back to my general counsel and I say, hey, we just signed up to do this. He's like, you can't do that. We can only spend $5,000. We can buy one seat. We can't buy 15 seats. And so I'm thinking, how am I going to get 14 other people to come see a Republican congressman from the Southeast in San Francisco at $5,000 a pop? Like, I don't know how that, and I pulled it off and we did it.
I'm just happy you didn't call me.
Yeah, she's a Pete. And, and so we made it happen, but it was kind of one of those things where, well, you kind of have to do it. And, I think that what I like on the lobbying side is when you can find alignment with the administration. So one of the things the administration is very, very focused on right now is mortgages for lower income families. So, or moderate income families. So you're talking, $150,000 to $250,000 mortgages. Well, you can't do those profitably today because it costs you $11,000 to create a mortgage to sell to Fannie Mae or Freddie Mac. So you think about a $200,000 mortgage, that's 5.5 points that you pay to create it. You don't sell that for 5.5 points to Fannie Mae and Freddie Mac. And so, one of the discussions I was having with some of the entities in DC yesterday was, costs us $1,000 to create a mortgage. So we can do those profitably. Like, why don't we lean in and use blockchain to do that? And that's where you get excited. And, where you have that alignment between what you're trying to accomplish and where the administration's trying to go. And those are a lot more exciting than stocking a breakfast in San Francisco for a Republican.
I'm guessing the other side is lobbying as well. If I'm one of these folks extracting rents, to use your word, and I'm getting 125 basis points for being a broker, like I'm Visa, for example, they've got to be pushing back hard. And so how do you see that in negotiation? You're not negotiating directly with them, but they're on the opposite side of the table from you, I assume, unless I'm missing something.
Yeah, and it's one of the reasons why blockchain hasn't moved faster than it has. I think there's three headwinds that blockchain has had. One is its ability to shoot itself in the foot, recurrently. So the ICOs, the NFTs, FTX, and so on. One of the issues has been the regulatory framework for the last 4 years, which has been very, very brutal to blockchain. And, we tried to go public last year and we just couldn't do it because we were too Web3. And it was frustrating, but it was what it was.
I mean, there haven't been really anyone that I can think of in Web3 that has done well. That's sort of, you guys could be one of the first.
Yeah. And obviously Circle had a phenomenal IPO and we're hoping that we would have something similar in the not so distant future. But we built a very large, profitable, rapidly growing business on blockchain despite those regulatory headwinds over the last 4 years. But the third reason why it's taken a long time for blockchain to really drive the disruption that it will drive is the natural disruptors or the natural adopters of the technology. It is so disruptive to their own core business that they won't do it, right? So like Visa and MasterCard have blockchain efforts and you're like, oh, if you really had bilateral transactions, there is no Visa or MasterCard. And by the way, when the stablecoin bill gets passed, I believe JP Morgan will push a payment infrastructure or a payment rail that does not involve Visa or MasterCard.
And just a quick question on that. And again, this may be a naive question, but I mean, do they do that on Ethereum? They have to do it on top of something?
Yeah, they'll do it on a public network. And Ethereum is a possibility, albeit, it runs some challenges in both cost and certainty. And no one wants to go and swipe their debit card at the terminal and then get a notice that you're not written onto this block. Wait 10 minutes, right, and try again. So you want the proof of stake networks are a lot more faster and predictable, and I think those are better networks for payment infrastructure, like Provenance or like Solana or like Avalanche or Stellar, and so. But the challenge is that why is Visa going to do a blockchain effort? Why is DTCC going to do a blockchain effort? Like if these entities are successful, their business doesn't exist. And I remember I had a conversation with one of these entities where they made a claim about blockchain and its inability to service the market the way that it should. And so I stood up a proof of concept and I showed them how blockchain could do exactly what they said it couldn't. And they said, well, what do you want us to do with this? And I said, well, you could lean in and figure out what role you're going to play in this new ecosystem, or you could just keep telling everybody it's not going to happen, but it's going to happen. And, they took the latter approach. And so, but this change is inevitable, and it's inevitable because of how much value it creates, and people will lean in and adopt and drive it. And again, with the things like the stablecoin legislation, the market structure bill that's going to get passed shortly thereafter, I think we'll have a legal framework to actually lean in where we don't have to wake up every morning wondering if there's an arrest warrant out for us, which, is the last 4 years in the blockchain space.
To me, that seems like the tipping point. I mean, once that is passed, if some version of the Genius Bill passes, then there's a context. If I'm Goldman Sachs, I know what to do and I know what the guardrails are.
That's right.
And so to me, that seems like the biggest hope for an acceleration of blockchain.
Yeah, I think the combination, we lost a big headwind when the SEC said they were no longer to use enforcement as a policy tool. That was key because they had been doing that in the prior 4 years. It made a very difficult situation and a lot of uncertainty in the blockchain space. But the tailwinds hadn't started yet. The Stablecoin Act will be the first tailwind. The Market Structure Act will be the second one behind that. And what you're seeing is last year, there was a lot of aversion in the public equity market to blockchain companies, Web3 companies. What you're seeing, certainly, look at the Circle IPO and how that's traded. There is, the public market is starved for access to Web3 opportunities. And they want to lean in and deploy capital there. And they should, because it will be, in my mind, it will be the most transformative technology of not just our generation, but the generations before and after us.
I'd be remiss if we didn't talk a little bit about SoFi. You were one of the co-founders of SoFi, which ended up being an incredibly successful company. I think the current market capitalization is, north of 15 billion. You and I have talked in the past about just the natural frictions that happen in the entrepreneurial process. And one of the main questions I get from founders is, how do you deal with the equity split amongst founders? How did you guys figure that out at SoFi, and did it evolve or was it static?
Yeah, it's an interesting question. When you're starting a company, and certainly when we started SoFi, we had ambitions of what it could be, but it was far away from that. Working out of Stanford and thinking about how to pull the company together, and so there's a couple of dynamics when you're an early stage company, and especially when you're a first time founder or second time founder. Even when you have one under your belt. You don't really know who's going to contribute what over time. And so you try to do something that's equitable in the beginning and with an agreement that, hey, we'll adjust over time to make it commensurate with the contribution that each person's putting into. But what you find, and I'm guilty of this myself, is everyone feels their contribution is the most important and the most critical. And so there really is no desire to do any adjustment or changing of things over time. And so that creates a tough dynamic, and certainly we have that experience at SoFi, and it was forced in an interesting situation where we initially divided up the equity in a way that we thought was commensurate with the experience and the skill sets that we were bringing into the business, into the opportunity. And we were very fortunate that we went out, initially the first raise we were doing was $2 million, and we were doing it at a $4 million pre-money valuation, because back then, these numbers sound very, very small these days, but back then that was a significant raise in 2011. And, the general expectation was you were giving up 33% of the company to your venture investors. And it was so oversubscribed that, and with a bunch of people that we felt were very strategic, that we ended up taking $4 million, but we didn't change the valuation of the business. And that was one of the biggest mistakes we made, because all of a sudden we gave away 50% of the equity. And you can imagine the negotiations with the investors at that point, and saying, oh, we can't do this. Well, we're not coming in. It's a game of chicken and egg between founders and entrepreneurs. And in particular, you find a lot of situations where you're trying to raise capital, and the venture investors will say, look, I want to put $10 million in. You're like, well, I only want 5. And they're like, well, I'm not going to do 5. I'm only going to do 10. And you have to decide how credible that threat is as you're going through the process of negotiation and standing up those rounds of capital. But we made a strategic mistake that we didn't adjust the valuation. We took more capital in. We diluted ourselves 50%. And our expectation was, well, it's all right. We'll figure out how to do this over time. We'll open up new equity and so forth. And we went to a situation where we had an enormous amount of success early on. We pioneered the student loan refi product, and there was a huge amount of demand for that product, and it far outstripped the amount of capital that we had from alumni to invest in that product. And so one of our investors came to us and said, hey, look, we need capital. I'm going to take you to Japan. We're going to raise some real money. And I said, that's great. I'd love to do that. And we went to Japan, and the first conversation, we met with SBI, which was the spinoff from SoftBank. And at the end of the discussion, they said, well, how much money do you want? And that was a strange thing for me. I hadn't actually thought through it, and I didn't really have an exact answer to that question. And so I said $10 million, because we had just raised $4 million, and I thought $10 million was a big number. And the investor that brought me kicked me under the table and looked at me, as if I just made the most horrible mistake in the world. And we went outside. He's like, "You idiot! We're in Japan. You need to ask for big dollars." And I was like, "Okay, big dollars." I'm like, "All right, I've got a company that's less than a year old. It's barely making any revenue. It doesn't have enough capital to fund loans, but I'm going to ask for big dollars." And so we went to the next conversation, next meeting. And that was with Rakuten, where I met Mickey Tanasan for the first time. And, he's been a long-time investor of ours, and all the way through Figure as well. And he said, well, how much money do you want? And I said, well, I think at the time I asked for $25 million or some number like that I thought was just an enormous amount of capital for the business, given where it was. And again, the investor who brought me looked at me, and it shot daggers in me. It's like, oh, you idiot, what are you doing? And I realized I should have had a discussion with him about what we were going to do into that next conversation, and I didn't. And so we went to the last meeting, which was a SoftBank, and we sat down, and I was 10 minutes into the pitch, and Masa stops. He's like, all right, I've heard enough. And I thought he was going to say, get the hell out. But what he said was, how much money do you want? And I gathered everything I could, and I looked him, as clear-eyed as I could. I said, I want $100 million. And he's like, all right, I'll give you $100 million, but I want 50% of the company. And I said, oh, no, we could never do that. And meanwhile, in my mind, I'm thinking, this is probably one of the best trades we'll ever do, because, most of this thing's worth $100 million pre-money. But I was like, absolutely no, we just couldn't do that. That wouldn't work. And so we had a back and forth discussion, and I was trying to be as persuasive as I could about the size of the market opportunity, and why this was a once in a lifetime opportunity, and the fact that he finished the conversation 10 minutes into the deck and realized right away what the opportunity set was. That clearly warranted something that wasn't 50% of the business, and so we ended up agreeing to a number that SoftBank was going to put in $100 million, and then one of my other investors, Ren, was going to put in, I think, $75 million or whatever that number was. And so, we had a $175 million commitment, which was phenomenal, because at the time we had obligated into, I think, something like $70 or $75 million of loans that we had to fund. And I distinctly remember sitting in the airport in Tokyo on my way back, and my wife called, and I was, jet lagged and everything was very surreal to me that I had this term sheet for $175 million. And she's like, are you sure it's not in yen? And I said, no, it's not in yen. It's in dollars. Trust me.
Only a wife could do that.
I pulled it out of my pocket, unfolded it, looked at it. I'm like, nope, there's dollar signs there. This is really a dollar term sheet. And so, I came back to the States and I told my co-founders, hey, open the spigot, start funding whatever we start committing whatever we could. We couldn't fund anything because we didn't have the money, but start committing whatever we could. We got $125 million coming in. This is phenomenal. And everyone was really excited and there was a round of high fives and, people weren't thinking about the dilution that much and what that meant in terms of their ownership because it was just such a big number and it had happened so quickly. I mean, we were less than a year old at that point. And, the SoftBank team came out to due diligence and a week passed and they left and another week passed. And I started to get kind of concerned about, well, when is this going to close? When we're going to actually get the cash? And, I distinctly remember I was flying back from New York but on the flight back, I had gotten this message from one of my investors saying, hey, need to talk urgent. It's about SoftBank. I call this guy and he's like, bad news. SoftBank's not in. And I was like, what do you mean? He's like, they can't do it. And I was like, but that's not good. He's like, but don't worry. We're in, we're going to do $75 million. And again, that was about what we had committed into at that point in time. And I said, but you're a public company, how do you just flippantly say we're in? You need to go to your board. He was like, nah, don't worry about it. And so I worried a lot about it. And a couple of days later, I was sitting in the office and he had called me up and he said, bad news, we're not in. And I remember distinctly, we had this big screen that would flash yellow every time we approved a loan. And I'm watching this thing and I swear it just started flashing yellow faster and faster as I'm having this conversation that we have no money to fund loans, that all of a sudden we now have $80 million of loan obligations to fund into. And, there's a structure where when you pull people's credit, you commit to finance them. If you don't finance them, that's actually a criminal offense. And my name was on the lending license. And so I'm watching the screen blink and, it's saying prison. Now, this is horrible. And I called him back and I said, look, let me pitch your board. Give me a shot to talk to them and talk about what I'm doing. And he's like, great. And we set it up for the following morning. And a lot of them were in China. So it was very, very early, 4:00 meeting. And I went home that night and, but that's my wife. I'm like, why did I even start a company? Because, I had good hedge fund, things were, and she's like, you did it because it's what you wanted to do. And I was like, I know. And so I drove down to one of the board members' offices at 4 a.m. on Sand Hill Road. And I gave, what I thought was probably the most compelling pitch I'd ever given in my life. And I tried to be extremely persuasive about, the market opportunity, the first mover advantage, how we were uniquely situated to solve this problem. And we finished and, everyone said, thank you for coming in, Mike, we'll talk it over. And on the drive back up to San Francisco, one of the board members called me and said, that was the best pitch I've ever heard in my life. We're in for $25 million if you can find a lead to price it. And so one of my seed investors was Steve Anderson from Baseline. And Steve said to me, look, I believe in this business so much. I will lead around. I'll put $15 million in. So Steve, I don't think had ever written a check over $1 million at that point. And
that's amazing.
And it was a huge thing. And I said, okay, that's great. And so I went back and I said, Steve's going to lead for 15. So I had DCM come in for 25. Then my other investor who thought he was in for 75 called back and said his board gave him approval for 50. And SoftBank came back and said, hey, we're in for 15. And so, whatever that dollar amount was at that point, I was at 105 or whatever the dollar was. And I went back to Steve. I'm like, Steve, this is great. We have $105 million. He's like, well, tell me who's in. I said, well, it's DCM, Ren, and SoftBank. He said, kick SoftBank out. And I said, well, what do you mean kick them out? He's like, well, they almost torpedoed your whole company. I don't want them in the round. I'm not going to lead if they're there. And I said, well, that's very uncomfortable. And so I never had that experience before. So I had called them up and I said, look, the round's oversubscribed. You said you weren't in, now you're coming back in. We don't have room for you. And in very typical fashion, they said, no, we're in. And I'm like, no, you're not. They're like, oh, we'll call you back. And they called me the next day and they said, we decided we don't want to invest in your company. And I was like, all right, fine. It's a nice way to save face. You didn't want to do it. It was your decision, not my decision. But then we started dealing with the reality of the dilution. And, the founders had already gotten diluted 50% off their original stakes, right? There was already an employee pool as well that further diluted us. We said, geez, we need to get some equity back. And I was looking at my own situation being, well, this doesn't seem anywhere near as attractive as it was when we started. And maybe I just want to go back to my hedge fund. Like, I don't know, the economics don't make sense. So I went to Steve and I said, hey, look, we need to do something. We need to kick some equity back into an employee pool, which the founders can get some of that equity. And he said, well, no, I'm not going to get diluted. And I said, well, then what, I don't know what we're going to do because, we need, and he's like, well, you're going to reallocate the founder equity. And I was like, well, what does that mean? How do you even do that? And, you go through all these cases at the GSB, nobody ever does the case where you have to reallocate the founder's equity. There's lots of things that are tangentially relevant to what you might do when you graduate, but there are very, very few things that are as bang on as this one. And it was a really complicated problem. And I had to go to my founders and, because we were oversubscribed, we worked out a structure where we gave people some cash. So people got 7 figures out of this and, within the first 12 months, which was a great outcome. Plus they still had equity. But it was a tough situation. And everyone said, well, I had 3 other founders and it was kind of universal. Each of them said, well, what if I don't take this deal? I'm like, well, if you don't take the deal, then you're not going to have any equity because, and it was one of the most challenging discussions. And it, I know the topic of your podcast negotiations, it wasn't even a negotiation. It was more of delivery of bad news. It created an enormous amount of strain and it gave me a lot of perspective around, the initial discussion that we had and the negotiations we had around how we allocated equity. The mistake that we did is we allocated all the equity. And what we should have done is we should have said, look, we're going to allocate 20% of the equity to ourselves as founders, and we're going to have 80% in a pool, and we'll figure out what to do with that pool over time, right? We shouldn't have just split it up the way we split it up, where we own the whole company out of the gate. And that was one of the big takeaways I had from that. And had we done it that way, it would have saved a lot of challenges and frustrations that folks had as we had to go through that process. But it was a learning experience, and at some point we should probably write a case and send it back to the GSP on how we went through that. And the 4 of us could get together and collectively write that.
Well, I love the story. There are probably 10 points, and I don't want to take the time to review all of them. Perhaps the first and most important point is good thing you didn't take your hedge fund and fund capital markets transactions, because there's another guy that got in a lot of trouble for that.
Yeah, I didn't want to be that guy. So I was trying to avoid that. I was thinking about going to some of my big hedge fund anchors and saying, look, I need an $85 million loan. I didn't, the challenge with that is particularly hedge fund investors, they smell blood in the water. They'd extract, not just 1 pound, but 5 pounds of flesh on that one. It would be the most expensive capital I ever raised. So we were fortunate and we really thread a needle and ended up building something that was very special.
Yeah, you certainly did. Let me just kind of underscore a lesson, because I have also made that mistake in terms of allocation of founder equity. The assumption you have to make, and you alluded to this, is that people are not going to change in terms of their contribution over time, that the initial allocation was the right allocation, and that flexibility isn't needed. And so I think most entrepreneurs get this wrong. And so your advice is wise there, that you should have a flexible structure. Because no matter how well you know your co-founders, I mean, we'll talk about Figure Markets, and you know that co-founder quite well, they're not necessarily going to do what you think they're going to do. And they don't even know what they're going to do.
No, that's right. And the thing is, you might have the most phenomenal COO, CFO, CEO at that stage of the business, but as the business grows and scales, it presents different challenges and different skills required. And so, you find a situation where people grow out or the job grows past them. And other situations where people grow into the opportunity. And so you don't know. And as a startup, you think you're going to do X, and the reality is what you're going to end up doing is probably going to be very, very different than what you set out to do. And, I always view it as a sort of a pachinko ball that you never know the path you're going to take and, what manifests in terms of product market fit and, how you scale your business and so forth. You're just trying to build something big. And so because you don't have that predictability and certainty, it's just very hard to know day one who's going to do what for the next 5 years.
A company like SoFi, you're hiring superstars. I mean, these kids are either coming out of great educational programs or other startups, and they have big egos. Talk about what you've learned about hiring the superstar versus someone that's going to fit culturally, because you and I have talked about that a bunch in the past, and I think you have some real wisdom on it.
Yeah, I think that at SoFi, culture was more of a secondary consideration because, again, we just didn't know how fast we were going to grow and how big the opportunity was coming into it. SoFi was born out of the entrepreneurial study class at the GSB, where you effectively go through the startup process, you do pitches to venture capitalists and so forth. And the original incarnation of what we were going to do was actually on-demand video services. So, we had this idea that you would go on a marketplace and pay someone to teach you how to change a tire or bake a cake or whatever it might be. And, but very quickly we realized that there was this significant opportunity around student loans, and we pivoted. The issue is that not knowing what you're going to be in the organization, and in particular, the people that you're working with and kind of your first time together, you don't really have an appreciation of how important culture is at that stage. And you will learn pretty quickly how important it is. And we made the mistake that we hired talent, then experience, or maybe even experience, then talent, and then cultural fit was last. And the challenge is we hired some superstars that were incredibly gifted at what they did, but they were just, assholes. And everyone says, well, we have a no asshole policy. I've seen plenty of assholes in lots of organizations. People tend to say that, but they tend to look past it. They don't actually believe it. And it caused a lot of problems for us, and and myself included. And so, what we did when we started Figure is we spent a lot of time as a founding group just talking about what was important to us from a culture and value standpoint, how we all wanted to work together, the organizational structure, what our expectations were of each other. And, when we went to start Figure, we had capital day one. And, there were a lot of SoFi investors that wanted to put money in Figure and a lot of new investors that never got into SoFi that wanted to put money into Figure. And I held everyone off for 3 months. And I spent 3 months with my founding team, like just vetting all this out and figuring out, organizationally, culturally, structurally, how do we want to be? And, it was one of the most important exercises on that. Or there are things that aspirationally you wanted to be, or that you felt were important to say you were, but you didn't actually believe it. And those are things that you're not going to adhere to and aren't going to stay along as core values. And so, there was just a lot of discussion amongst the 5 of us. And it was a relatively large founding group at SoFi. It was myself, it was my wife, it was, Lana, who worked with me at SoFi, Sarah, who we hired from another FinTech, and Cynthia, who we hired from another FinTech. And there was just a long discussion about culture and organization and alignment. And I think it's played out really well for us.
Do you think you've gotten, you're on your 3rd or 4th startup. And so just talk a little bit about that, about your evolution as both a founder and a leader, and figure out what you're good at, what you're not good at.
Yeah. I think the biggest thing, the biggest thing that I've learned, and we talked about this earlier, is just appreciation for culture and hiring people that are aligned and everyone's rowing in the same direction, right? And whatever the values are that you're adhering to. And there aren't, I don't believe that there are right cultural values for any organization. They need to be true to the individuals that are there. What's important is to hire people that share those values, right? And align them in. And when you do that, you have that proverbial everyone rowing in the same direction. You're infinitely more effective than a cadre of superstars that don't get along. And so that's one of the most important things. The second thing that I've taken out of this is I've lived through so many near-death experiences. Like if you look at SoFi, and I told you one in the beginning in terms of what we did with the funding side, that was one of a dozen situations like that. And when you look at a startup on the outside, you see this linear trajectory, right? $4 million valuation, $100 million, billion dollar valuation, right?
And now there's a stadium in LA,
and now
SoFi
there's a stadium
Stadium.
in LA. And you're thinking, oh, wow. What you don't realize, especially in the early stage of that, it's like an EKG, right? Like you go from near-death experiences daily, weekly, And what you learn out of that is never get too excited when things are good and never get too depressed when things are bad. Be even keeled, be pragmatic, and realize that almost always there's a way to work out of a problem. And, I remember when we started Figure, and I was with my wife and my kids at one of the amusement parks in LA. We'd gone down for the holidays for like a 3-day vacation. And I was riding roller coasters, which I hadn't done in a very long time. And it turns out I can still do it, but I wouldn't do it for fun anymore. But I got a call from my CFO, my general counsel. And, at that point we'd done, I don't know, maybe $500 million of loans. It was very early on in the life of Figure. And we were trying to do a loan sale with someone, and they brought in their outside counsel. Their outside counsel came in and said, these loans aren't actual mortgages because you didn't do XYZ. They're all illegitimate loans. And I'm thinking, they were thinking, oh no, we have $500 million of loans that we can't pledge into a warehouse, we can't sell, and we're gonna have to put it, we don't have $500 million, we don't raise $500 million, we raise $100 million, the world's gonna end. And, for me, they called up and I was like, look, we have to raise $400 million to figure out how to do it, right? Because I just flashed back to, when we needed that $85 million for student loans when we started SoFi. There's just, you can, if the business model makes sense and you're there, you work your way through. But I also didn't believe what the outside counsel was saying. And it turns out they were wrong. And the loans were mortgages and they were fine. And, everything was great. But my two senior folks, they were literally just beside this. We don't know what we're going to do. You have to fly back right now. This is Armageddon. And I'm like, no, I got a few more roller coasters I got to ride, with my kids. I'm going to do that. I'll call you later tonight, but it'll be fine. Don't worry about it.
Love it. Love it. And so no reason to get your blood pressure too high unnecessarily. I think just finalizing, we're just about out of time. I wanted to ask you a couple kind of quick, just personal questions on negotiation. You've probably had to deal with some difficult people in your career, whether it's employees or regulators or, just the people. So if you had to signal out one person, you don't have to say what their name is, that was most difficult and how you learned to deal with them, who would that be?
Yeah, I think going back to the story about Steve was probably the most difficult person I had to deal with because I had almost no leverage in that negotiation, right? I had a little bit, which was, all right, it's just not worth it. Right, I'm going to shut it down because he had money in the business. He would have lost. Wouldn't have been a large dollar loss for him because he hadn't put the $15 million in yet. So I had a little bit, but I didn't have a lot. And Steve is a very principled guy. I would argue sometimes he loses sight of the forest through the trees and things. He might push back on that. But it was very challenging because he was just steadfast in his position, and I didn't have leverage to push back. And, one of the things that I've discovered, because I have to negotiate with everybody all the time. I have to negotiate with my employees, my investors, my customers, the regulators we talked about earlier. And, what I've discovered is one, I need to go in the best levered position I can. But two, I need to know what my reserve price is and where I'm just going to walk away and be actually willing to do that. And, I've had a couple of situations over the last year where I stood up and I walked away and they came back. And, and my position was anything less than these terms, I'm not going to be happy with this. And so, we've crossed that threshold. I'm done, I'm pencils down, I'm out. And, I think just knowing that coming into the discussions versus kind of on the fly, let's see where we land, and starting well away from that point, right? You don't want to start at your reserve price because you have nothing to negotiate from at that stage. That's been extremely helpful. The other thing that I've learned and that I really try to reinforce is people too often will negotiate with themselves before they're negotiating with the counterparty. And they'll think about, oh, well, they won't want this. They won't want this. We'll have to do this. We'll have to do this. Let them ask for it. Don't do their negotiation for them, right? And that's critical. And I have to reinforce this to my folks all the time. Stop negotiating with ourselves. Let's just go out with a big ask, let them whittle it back. We know what the reserve price is. Let's not think about all the issues we have and and make amends or accommodate for that before that's even brought up as a point.
Yeah, I think this one, I just want to underscore this because it's so important. I always tell people, go into a negotiation with an attitude, there's something that I could learn from them that might change my perspective, as opposed to I'm just advocating. Because it might be that they would do something that's much more favorable to you that you had no idea unless you go through that inquiry process. So people say to me, what are the great skills of negotiators? And I say, ferreting out what they really care about while maintaining your leverage. And, leverage is important, but the reality is sometimes you don't have the leverage. In your career, we could spend another hour on the places you didn't have any leverage and weren't able to bluff and still got something done. Yep. And so I try to tell people leverage is important, but all the process stuff, the framework stuff that we talked about earlier, I think is really important.
Well, and you hit on a really, critical aspect. And I'm an economist, so I use the term Pareto optimal, right? And Pareto optimal is when, two parties can trade something and both end up in a better position. And so a lot of negotiation is finding that Pareto optimal condition. What do you care a lot about that I don't care about at all? What do I care a lot about that you don't care about at all? Let's trade that off, right? And that process is iterative, but that's how you get to outcomes that everyone comes out feeling happy about.
So important. And so, the phrase, my mentor was Roger Fisher, who coined the term getting to yes. The second book that could be written, and maybe this is your retirement gig, is getting to optimal. Because just getting to something that both sides would agree is way short of optimality. Right. And you can't, optimization that curve is in theory almost impossible to eventually rest upon. And so I just think that's important. We should reward employees not for getting a deal done, but getting the best deal possible, having spent a bunch of time negotiating. And that usually isn't just exercising leverage.
That's right.
Anything you'd like to improve as you go forward in negotiation? If you thought, gosh, if I were only a little bit better about this aspect of negotiation, what would it be?
I'm always looking to improve, and I'm not an expert in anything that I do. I've been very fortunate that I've been surrounded by very talented people, and we've been able to build some large enterprises off of this. If you take Figure and SoFi and Provenance, we're now at 3 multi-billion-dollar enterprises we've built out. But I'm constantly humbled every day in terms of what I don't know. And I think, as it relates to negotiation, patience, empathy, trying to build your emotional intelligence and understanding the perspective the other person's coming from, those are things I can always work on and always do better at. And so, I'm finding I'm 54 years old at this point. And, when I was 40, I thought I didn't have anything else to learn. And now I feel like every day is a great learning experience, and I'm excited to have the opportunity.
Great. Well, that's a good place to end. Mike, thanks for being on the podcast.
Thanks. I appreciate it.
Thanks for listening to All Things Negotiation. Please subscribe to the show on Apple, Spotify, or YouTube. If you enjoyed the show, tell a friend, and be sure to engage with us on social media. Your likes, comments, and reposts make a big difference and help others find the show. The show was produced by Ezra Trupiano, original music by Peter Breinhold, and designed by Aubrey Benson. Thanks for listening.